Welcome to the Gold Newsletter Podcast, your bank of knowledge of investment, economics, and geopolitics. Go to goldnewsletter.com for our publications and archives.
This is the Gold Newsletter Podcast. Thanks for tuning in. We've got a special offer going, goldnewsletter.com/bonus. Get Brian London's top 2 mining stock picks and the Golden Opportunities newsletter. Today we have Rich Checkan, President and COO of Asset Strategies International. That's assetstrategies.com. He has a monthly publication and he studied chemistry at the U.S. Military Academy in West Point. He's been a guest before, and his past appearance was Resist the War on Cash. Rich, welcome back.
It's great to be back. Thanks, Fergus.
Yeah, and you just mentioned that you've got an article coming out tomorrow, which we're recording this on the 8th of January. You were just saying that we continue to live, and Brian London, who also joins me today, has mentioned this unprecedented easy money era, and the implications of that, both for, let's say, the precious metals realm and then regular stocks. Do you want to expand upon what you have to say in that piece?
Yeah, the bottom line is this is not a new trend. We've seen it for years upon years. Ever since the Fed was created back in, 1913, the dollar has, to some extent, lost purchasing power. I think when it was tied to gold, it did a better job of kind of holding on. Of course, I think when we confiscated metal in 1933, that was about devaluing the dollar. So we lost a little bit of purchasing power there. When we decoupled the two in the 70s, gold and the dollar, that's when, the governor was taken off. There were no restrictions. Nobody was balancing the checkbook, and, politicians were free to spend to get elected. I think there's no other way to look at it, and then to hold their jobs. So like every other civilization before us, fiat money controlled by a government with their particular interests is not a store of value. It's something that's going to be diluted or diminished over time. And then when you use that as your measuring stick to measure real assets like gold, over time it's going to take more of those measuring units to buy that ounce of gold. It takes more dollars over time. Gold is a true measure of wealth and a true store of value. In this past year, and actually dating back to the financial crisis, 08-09, the response has been to make money so free and available to create that wealth effect, if you will, for consumers and make them feel good about the economy. All assets are floating up. The stock market, gold, everything's going up that's measured in dollars because the dollars are worth less.
Rich, that's an important point. We had the tech bubble in the late 90s. Then we had a real estate bubble in the early 2000s. And for lack of a better term, or perhaps for the better term, everybody's calling this the everything bubble because everything's blowing up. And we've gotten to the point, and actually it's been, like you say, ever since the central banks, the last tie to gold was cut in 1971, the central banks have been just spending money, and they've had free reign. They have had no restrictions whatsoever. And at every downturn, they've lowered interest rates. They've come up with more liquidity in the markets, and at every successive downturn, they've had to do more of that to get the same effect in the economy, to the point where we're at just ridiculous levels, 5,000-year lows on interest rates, debt so large that it's impossible to ever have interest rates normalized again because the debt service costs would be too great at any interest rates more than 1 or 2 points above what we have right now. The bottom line is this isn't just easy money, it's ever easier money, and the markets are addicted to that. All of the markets, except the precious metals, of course, or gold and silver, are addicted to this constant influx of easy money, and they're going to demand lower and lower interest rates. And my view is that with debt loads as high as they are, we will have negative real rates forever as long as this monetary regime is in effect. And that's going to be tremendously bullish for precious metals, as you say, for retaining value, for being that anchor as everything else gets depreciated.
Hey, Brian, I couldn't agree more. And, when you spend more than you take in, you have a problem, whether it be at the personal, corporate, or governmental level. And they're well beyond the point of having a problem at the governmental level. The problem is that their job, as they see it, I would assume, is to make the public happy, make the consumer feel good, and therefore give the impression that the economy is floating along. But you look at the amount of money that's being pumped into that economy, the component that is done by public institutions, state, local, and federal. It's unbelievable. You're a businessman. Is it by any way even conceivable that your business is going to be more profitable by you buying your own products? No way in hell, right? That doesn't help anything. What it does do from the governmental level, though, is it gives the impression that the economy is stimulated. It keeps them from having to, I guess, collect more taxes. The tax is still being paid by the consumer, but they don't see it. It's being paid in the way of inflation and higher prices for the same goods and services. So they're still getting taxed, but I guess it's a way to swallow it and not know what the pill is.
Yeah, and that inflation has not been kind of the classic inflation that we've seen in retail prices for a number of reasons. Part of it being that you have all these developing economies like China and elsewhere in Asia that are supplying cheap products into the markets, when you have this labor cost differential. And part of it is because the Federal Reserve has protected the banks and kind of gotten all this liquidity enclosed within the financial system. So it's financial assets, and they've targeted real estate and equities to try and boost that up for that wealth effect. So that's where you've seen the inflation. The question is, at some point, this kind of inflation will cascade over into the economy and will result in kind of the classic retail price inflation. And especially now, in that a lot of the purchasing that the Fed is doing, people don't realize we're in QE again. The current levels of Fed asset creation actually exceed QE1. They started off at that, now they're exceeding that. And what's happening now, it's direct purchase of Treasury securities, no CDOs or anything else. It is just absolute full-out monetization of debt at a greater level than we had at QE1. And this is right now it's still in stealth mode because the Fed is denying it. But it's already underway.
And they make no bones about it, Brian. When Fed Chairman Bernanke, I want to say it was like 2012, I'm not sure, he made some comments after one of his FOMC meetings. And he talked about their plan. He just laid it out for everybody to see. He said, if they allow the level or the prices of homes to increase, if they allow the prices of equities to increase, so people see an increase in the value of their portfolio and their homes, they feel, that's a key word, they feel like they're wealthier, and they are more willing then to spend money to buy products to be able to allow these companies to hire more people, R&D, expand, what have you. But it's all about this wealth effect and making people feel richer. They're no richer. They have the same amount of assets. They might even have less. They're just valued more by those weak dollars.
Yeah, and it's all that economic foundation of modern economics of aggregate demand that it doesn't really you're not creating wealth, you're not saving, you're not creating capital and investing and everything else. You're just spending, and kind of this circular motion of monetary velocity. And it doesn't really matter where that aggregate demand comes, whether it's from the consumer or the government telling people to dig a hole, then fill it in.
Shovel ready.
And shovel ready, and just keep moving, even if it's in a circle. And that creates a booming economy and growth, et cetera, in their view.
What are you growing?
Exactly. We could go off on that on a whole other podcast. But one of the things I wanted to address with you, Rich, is what's going on right now. People started to realize it's still not out there. You don't see them talking about the fact that we're already in QE on CNBC. But the public, or the smart investors, already know that. And gold is, I don't know how you guys felt about it, but we predicted again that we were going to have the early year gold rally start in the second half of December. which it did. And, we gained 4% from December, I think like 18th or so through December 31st in gold. And then the first day back in January, we had another good day, and the rally was full steam, and investors were just beginning to understand, and we're getting wider acceptance of the monetary factors that were driving gold higher. And then the missiles started to fly.
Yeah.
And gold shot up, and a lot of people saying, yippee-ki-yay, this is fantastic. And I'm like, no, it isn't. It isn't, because that's obscuring. The danger here is that that's going to obscure, these geopolitical issues are going to obscure the monetary issues. And they're going to conflate the two and then confuse the two and then say the only reason that gold was rising was because of these geopolitical issues. Then when things inevitably calm down, gold price drops, and it does significant technical damage and sentiment damage to the market.
Yeah.
So there's that real danger, and we've seen that. Even as we're speaking right now, gold soared with the Iranian reaction, and then when it didn't seem that bad, they were actually down on the day. So that we're seeing that play out in real time. What do you see? What's your view on that? The dangers of these geopolitical issues and how it contrasts with the monetary factors that really should be the prime consideration for investors right now.
The Gold Newsletter podcast is proudly sponsored by the Discovery Group of Exploration and Development Companies. To learn more about our exceptional track record and exciting future, visit discoverygroup.ca.
Hello and welcome to our weekly interview with the Discovery Group, which is the proud sponsor of the Gold Newsletter podcast. Each episode we get to know more about each Discovery Group company. I'm Daniel Duarte, editor of this podcast, and today I have the pleasure of talking with Stephen Williams, Vice President of Corporate Development and Investor Relations at Bluestone Resources. Stephen, thank you for joining us.
Thanks, Daniel. Really excited to be here and give an opportunity to talk more about Bluestone Resources and the Cerro Blanco gold project that we acquired from Goldcorp in 2017. We are a member of the Discovery Group, and John Robbins, one of the key members of that, is our executive chairman, and ultimately put Bluestone together and acquired the project from Goldcorp 2 years ago. So a little bit more about Cerro Blanco. It's a permanent high-grade gold project in Guatemala. 1.5 million ounces at over 10 grams per ton. Assets like this are rare and hard to come by, and so it was a big reason why a lot of us got excited and joined the company when it was formed in 2017, myself included. As a former investment banker, I'd looked at a number of projects throughout the years, and realized that the grade, the cash cost, and the structure and investors behind it all make for a compelling investment opportunity, and thus I jumped at the opportunity. We completed a feasibility study earlier last year that returned very robust economics, one of the lowest all-in sustaining cash costs in the space at $579 an ounce, generating some of the highest IRRs for a development project out there. I'll talk a little bit more about our timelines and some of the catalysts that we'll be looking at over the course of this year as we look to advance our project.
Mm-hmm. Back in November, when I spoke to Darren Klink, Bluestone CEO, he said you were on the verge of beginning construction. Do you have a timeline for building the mine and when it could begin operating?
We do. So we're well into the process for project finance. We kicked that off on the back of the feasibility study last year, and we're hoping to be able to put together that project financing package, call it Q2 of this year, which would allow us to ramp up development activities this year. And ultimately, we're looking to be in production by, say, Q1 of 2022. So it's about a 2-year build after we initiate development activities.
And so 2020 has kicked off with encouraging news for gold, especially over the past days, with prices breaking out 6-year highs. How is Bluestone planning to make the most of this trend?
Yeah, I think the timing works well for us as we're looking to, put our project financing package in place. And with the renewed sentiment and interest in the gold space, gold prices hitting a multi-year high, all of that, I think, contributes to investors looking for the next development asset or the next producer. And so that's where we come into play with that. We're permitted and we're looking to be able to initiate construction this year, which typically, if you look at historical development stories, as they come out of that development phase and into construction, there's generally a real re-rating opportunity there as they advance and de-risk the project towards production.
Mm-hmm. And finally, what are some potential catalysts that you see converging this year so that perhaps you can offer potential shareholders some reward?
Yeah, so this year is going to be a pretty exciting year for Bluestone, and definitely a pivotal time and transformation of the company. One of the big, obviously, catalysts is going to be a project financing package, followed by initiating construction activities. So, we anticipate to see that project financing package, like I mentioned earlier, call it Q2 of this year. Mm-hmm. We're continually drilling and looking to upgrade resources from inferred into measured and indicated. So there'll be ongoing drill results throughout this quarter, and then followed by that financing package that will ultimately allow us to kick off development of the asset this year. And so with that, it's a pretty transformational year.
Sure. It looks like it's going to be a very promising year for Bluestone. Thank you so much for your time today, Stephen, and for updating us on Bluestone and its opportunities.
Thank you, Daniel, and really appreciate the time to talk about the Discovery Group and Bluestone Resources as a company. It's an exciting time in the market.
Great. Looking forward to talk to you again.
Thanks.
No, those are the two important points, and I don't see it derailing the gold rally. It may stall it, it may hamper it for a short period of time, but I don't see it stopping the gold rally. We've talked many times over the years. I think we both saw this coming. I was just reviewing what I wrote last year in our kind of forecast issue in January, and I basically said that you have probably 3 to 6 months, this was last January, to go ahead and start accumulating your gold, that we expected it to do some damage second half of the year. Of course, I wish I could go back and shout from a megaphone, because of course the breakout occurred in June, 6 months later. But I also called for the dollar to start weakening. We're 8 years right now into a dollar strength trend that usually lasts 7 to 9 years before it reverts. And I think we're already showing signs of reversion, where you had the peak, I think last year was 99.5 on the US dollar index, and it's down to about 96 and change or something as we speak. So it's already lost 3% in a few months. So both of these things might be coming together. The gold rally is for real. You don't have a breakout like you had in June with such force and velocity without it being real, through such key technical resistance that's been building up for 2-3 years, and then to go through it like a hot knife through butter all the way to 1550 before retrenching, and the goal was to get through 1350, I think, accomplished. Yeah. So there's no question in my mind the bull market is here. It's here to stay. It's going to falter and sputter and then surge and sputter again, but it's going to go on a long time, I'm pretty certain, because that's what bull markets and precious metals do. I do think there is the risk short term of people attributing this to Iran, and it's a bunch of garbage. There were no issues, not of this nature, with Iran back in June. Okay, there were a lot of other things going on. I think it all comes down to the dollar, to debt, and to real assets. And eventually, like I said, greed will give way to fear. And I'm not saying you have to be fearful to own gold. I think you could be greedy and own gold too. I think everybody should own it all the time. But times like these are exactly why you already want to have it.
Do you want to clarify why you use that dichotomy, this greed versus fear?
Yeah, it's simple. People that are making money want to make more money, and that's what's been going on in the stock market for a decade. And I don't blame people. I'm doing it myself. So that's where you create profits, wealth, what have you. Okay? Where you protect it is with gold. And that's why you need to, in my opinion, have 10% in gold at all times, period. At certain times, I think you could be profitable in gold too. And I might add another 5 to 15% allocated to precious metals when you're coming off the bottoms and entering a new bull market like we have right now. So, for the past 5-6 years, all we were espousing is gold as wealth insurance. over the past year or so, we're actually telling people it looks like it's clear we're off the bottom, and maybe you could actually profit a little bit from gold and silver for a while here as well, because the bull market results in the past have been pretty spectacular. The last bull market, from the bottom to the top, gold was up 650% over 10 years. Silver was a 100 bagger, I guess, right? It was up 1,000%. So, but of course, silver's damage is done later on. Once gold sets a trend, silver follows and outpaces typically.
One of the notes about this asset protection, which I heard from you in another webinar, was just the way that gold has such a low correlation with stocks. You're just saying it's on its own path, basically.
Well, I'm fairly smart. I'm not a super smart guy. There are so many people out there that are much smarter than I. I think you may be aware, Brian, World Gold Council has done studies over the years and caveat their marketing arm, if you will, for South African gold miners, but they produce some fantastic research.
Yeah.
If you're not on their site, you ought to be getting their updates and their trends. But one of the things they've done periodically over time is they've looked at the performance portfolios in various currencies with various stock bond mixes and various levels of gold ownership. And what they came up with is, I think the sweet spot is about 8% of a portfolio in gold. Below that or above that, you don't get the same beneficial effect, but at 8%, what you get is you get increased performance of the overall portfolio and you get decreased risk of the overall portfolio. Now, 8% is hard math to do. We tell people 10% for that wealth insurance. It's easy to do the math on 10%, but that's where that number comes from. We didn't just throw spaghetti at the wall and see if it's al dente. That it comes from I guess a scholarly study where 8% is the number.
And frankly, Rich, I've been tracking that for about 30 years now. It's not just that study, it's lots of studies. It's all modern portfolio theory. What is the portfolio mix that hits that efficient frontier of maximized risk-adjusted return? In gold allocations every study has pegged gold between 5 and 10% in a portfolio. Physical gold results in that highest risk-adjusted return because it's a diversified mix, and gold historically has been somewhat contracyclical to other asset classes. However, that said, over the past 20 years or so, that's kind of fallen off because, again, this effect of the central bank, the Fed, coming in and mitigating any economic downturn with these floods of liquidity. And so all the correlations, especially since 2008, have essentially gone toward one. And what we're talking about, these avalanches of liquidity that come into the market on every downturn or perceived downturn or oncoming downturn, they're bullish for equities as well. They're bullish for bonds, and they're bullish for precious metals. So, it is an everything bubble. But when that bubble pops, the only one left is going to be precious metals, gold and silver. You kind of touched on an important point earlier in this podcast that I like to stress to people, that you shouldn't look at gold, that insurance portion of your precious metals portfolio, that 5 to 10% that you sock away, that's insurance for your wealth, everything you've worked for in your life. And you shouldn't look at the price of that. You should look at the price of other assets. You should look at that from a gold-centric standpoint, that it is the anchor and the values of everything else rise and fall around it. That gold isn't worth, $1,575, but that the dollar is worth 1/1575th of an ounce of gold.
There you go.
And
the measuring stick is wrong.
Exactly. The measuring stick is not changing on a daily basis. The measuring stick is that standard unit of measure, that atomic unit of measure that's sitting there, unchanging, unfailing throughout time, and everything else fluctuates in value around it. And once you do that, you just really learn to relax, frankly, about the gold price, and it's there protecting you.
Yeah, I don't care if it's high or low. There's no wrong time to own gold if you're buying it for the right reasons. There's no wrong price to own gold if you're owning it for the right reasons. And wealth insurance is the number one reason. Like I said, there are times, if you see the trend, where you can profit from it too, but that's a different pot, if you will, or a different jar
Yeah.
that I put the gold in. My wealth insurance I never touch. It's a store of value and with high liquidity for a potential financial crisis that I hope I never have. If I have
Right.
it, I cash in immediately. If I don't have one, my heirs are going to benefit.
But I tell people it's like fire insurance. You don't expect your home to catch on fire, but you buy fire insurance. And with gold, it's not like you don't expect the dollar to depreciate. You know it's going to depreciate.
Exactly.
So it's insurance against not a potentiality, but insurance against an inevitability. And that's why you absolutely have to have it.
And people will always come back and they'll say, well, look at the price of gold in dollars and how it fluctuates. I like better looking at what gold can do in the way of goods and services, right? The purchasing power. So, it's overused, but you look at Roman times, you look at the toga, business suit of the day, ounce of gold would buy it for you. In the turn of the century, 1900s, gold was what, $18 an ounce? A nice new suit cost $18 an ounce. When at the height of the all-time high for gold in 2011, it was $1,900. I could buy a nice new suit for $1,900. Brian, I could buy a nice new suit for $1,050 at the recent low, December 2015 as well. I can't buy a nice new suit for $18. Okay?
Yeah.
You got to look at what an ounce of gold can do for you in goods and services. I don't care about the dollars. We should be measuring dollars in gold, like you said.
Yes, yeah, and these suits, some of them are being made in Asia, and they're price. So
Get 8 of them.
that's going. I remember some people when gold was $1,900 saying, "Well, that's a pretty damn good suit," and I said, "Yes, it is a very nice suit." And we're talking about potentially $3,000, $4,000, $5,000 gold. That might get a bit out of whack for a while, but that's where you can make money in these market upturns, like you say, when you have that investable portion. You can do that in physical metals, certificate programs. You can do it in futures and options. You can do it in mining stocks like we focus on. And that's where fear and greed come together. That's that FOMO, fear of missing out.
Yep.
We talk about fear being a great motivator, greed being a great motivator for precious metals. We've talked about that for decades. FOMO is the one thing that combines them both. The fear of missing out. It's greed and fear mixed up in the same pot. And that is the most powerful motivator. So when things really get moving, yes, gold prices can actually overshoot. Although the kind of economic situation I see coming up is going to be difficult for gold to overreact to that. It's going to be, so supportive of higher gold prices. But that's the kind of thing where you use the investments. And like you say, you don't touch your core holding, your insurance. But you can play this game and really get ahead of the market, build wealth through precious metals, through not just physical trading of the metals, but also through some of the leveraged investments.
Hey, Brian, you talked about the fear of missing out, and it right away took me back to the stories that, Michael Checkan and Glenn Kirsch founded this company. Mm-hmm. Glenn Kirsch passed away about 10 years ago, God rest his soul, but Glenn used to run the 18th and K office for Deke Pereira downtown D.C., and they had a marquee outside where they flashed the gold price. So this is now in, late December of 79, January of 1980, when gold was hitting its high, the previous bull market of $850 an ounce. And there were lines around the city block to buy gold before it went higher. And there were people, fear of missing out, buying positions forward in a line so they can get their gold cheaper.
Really?
Yeah.
I have never heard that story.
Talk about powerful.
Wow.
About powerful. So
that's when you should
It'll
sell,
happen
of
again.
Course.
It'll happen again.
That's when you should be selling your trading positions.
Trading positions, yes.
Speaking of the physical positions, the insurance positions, in our remaining few minutes, why don't we touch a little bit on what you guys recommend? I'm a big believer in junk silver. It's typically the cheapest way you can buy bullion because there's no manufacturing costs involved, and it's smaller denomination. Sure, it's bulky, but it's smaller denomination and in a true crisis, that's exactly what you want, something you can actually use. But what are y'all talking about or recommending these days as far as that physical metals mix?
Yeah, I still like for that 10%, I'm primarily gold with a little bit of junk silver for divisibility. But I think gold is where you get your lower premiums, your most dense store of value, So we like mainstream gold coins. And I will also say that, if you're starting out, if you don't own precious metals at all, the first thing I think you got to do is you got to take delivery of it, because the bottom line is, if it's going to fulfill its role as a store of value for potential financial crisis you hope you never have with high liquidity, you have to have access to it. You got to be able to cash it out like immediately. Okay.
Which does not mean a safe deposit box at your local bank.
Exactly. And I'm not telling you store all your metal at home, but I'm telling you there are ways to be protected at home.
Yeah.
Number one is just keep the low profile, but that's where I think you got to start. You have to have access to it very quickly if you have the need. So we usually look at mainstream gold coins, eagles, maples, Philharmonics, kangaroos, whatever you can get fairly cheaply, Krugerrands for the dense part of that 10%. But we also like junk silver, as a piece of that for the divisibility. Junk silver is fantastic because you typically don't pay the premium, like you said, because there's no manufacturer cost. But when there are shortages, be careful. You can see premiums escalate like we did in the summer of 2015, where it went from what I think all into the consumer retail, 4 to 6%, which is very reasonable for divisibility. It went up to 45% premium. I'm not a buyer of junk silver there. Okay.
Right.
Period. When it comes back down to earth, I'd be interested again. But we love junk silver if you don't have to pay extra in terms of margin for that divisibility. It's probably my favorite form of owning silver. I'm there with you.
What's your view on the counterfeit risk with bars lately?
It's out there. There's a couple reasons why people would do it, and there's a couple reasons why people didn't do it for many, many years. The potential gain was so limited and the potential risk was so high that nobody did anything. I guess at some point with the higher prices of gold, et cetera, people thought that was lucrative enough where they can try this and it's worth risking the penalty. So we're seeing more of it. It's a real problem. It's out there, and I know ICTA, the Industry Council for Tangible Assets, is working very closely with federal enforcement to, clamp down on counterfeits, whether it be for numismatic or rare U.S. gold, bullion, bars, coins, etc. It's all being counterfeited. The best protection that I know of is buy from trusted dealers who buy from source distributors of the mints. There's really no better protection out there for you, and that hasn't failed that I'm aware of.
But even the coins are being counterfeited, because I had thought that the designs and everything else for a coin and made it much more difficult, and also lower denominations, because typically they're 1 ounce or lower, make coins much less susceptible to that counterfeiting risk.
It's much more predominant with bars. I think second is probably rare gold coins. Believe it or not, they're getting very, very good at putting old coins encapsulated and pawning them off as real. And then, major mint bullion coins as well, but probably in that order. Bars, I think, are the still number one threat.
Well, thank you so much, Rich, for your time. If you want to follow his work, it is assetstrategies.com. And the number you can call is 1-800-831-0007.
I was going to say, Fergus, it's easy to remember. We're 1-0 better than James Bond, just so you know.
Okay.
0007.
Yeah, so assetstrategies.com. And you can always get the show notes, review the links, many of the topics we refer to at goldnewsletter.com/podcast. Thanks for tuning in. Rich, thanks for being on the show.
My pleasure. Thanks for having me.
Great to have you on again, Rich. Take care.
Thank you, Brian.
Bye-bye.